Hello, everyone, and welcome to today's webinar, CPA Firm Retirement Journey, Comprehensive Planning for a Smooth Retirement Transition. Before we begin today's presentation, just some CPE information to go over. Horizon is pleased to be able to offer CPE for this web session. It is imperative that you adhere to the following instructions to obtain CPE credit. To receive credit, you must be in attendance for a minimum of 50 minutes. No credit will be awarded from watching the replay. Accounting today is not responsible for late arrivals or connections issues. There will be required polling questions asked periodically throughout the session, all of which you must answer. Please remember to click submit after choosing your answer. If you have completed the above, please allow up to 3 business days from date of today's session to receive an email from simplecert.net. The email will contain instructions on how you can download and print your CPE certificate. To ensure email receipt, please add simplecert.net to your safe sender list. Please note, CPE certificates will only be sent to those attendees who have registered and stayed for at least 50 minutes and answered all required polling questions. If you're watching in a small group, the person logged into the program is a small group facilitator. He or she must respond to the polling on behalf of the group and must monitor, document, and verify the active participation of the individuals in the small group. Please have the small group facilitator email support@virtualvenues.com within 3 business days a list of names, emails, and company of those registered in the small group for them to receive credit. And now, before we kick off the presentation, we'll have the first of those polling questions that were mentioned at the top of the presentation. Your first polling question is, what is the biggest challenge you're facing as you consider selling your CPA firm? And you can take this as a hypothetical if you're not currently considering selling your CPA firm, just what you would see as the biggest challenge if you were considering selling your CPA firm, just to make sure this applies to everyone. Your choices here are A, finding the right buyer who aligns with my firm's values, B, ensuring a smooth leadership transition, C, maximizing the value of my firm, D, managing client relationships post-sale. And once again, we are asking the biggest challenge you're facing as you consider selling your CPA firm, or were you to consider selling your CPA firm? A, finding the right buyer who aligns with my firm's values. B, ensuring a smooth leadership transition. C, maximizing the value of my firm. And D, managing client relationships post-sale. Just remember to click the choice that best describes what option you're responding with and click the submit button. It won't work if you put it in the Q&A panel. So let's make sure everyone has sufficient time to get their responses registered for CPE credits. And then we can kick off the presentation. I'll give everyone a final few moments. A final 5, 4, and just a reminder, you have to do it within the polling feature. 4, 3, 2, 1. And it looks like we have a good mix here, but nearly half say finding the right buyer who aligns with my firm's values. And now, to kick off the presentation, I'm going to kick it on over to Derek Davis. He is the founder of Green Rose CPAs. Derek, hand it over to you.
Awesome. Thank you so much, Danielle. Welcome, everyone. Thank you all so much for your time today. We're really excited to kick off this webinar today. We will start with Susan McGuire's journey. She is a very well-accomplished CPA. Who went through this retirement journey, so she can speak to a lot of the practical, tactical, emotional issues that she faced as she went through retirement with her firm. She was one of 4 partners. She actually stayed on with our firm, but 3 of her partners retired, so she can really talk about the issues that they faced. We'll talk about different types of buyers that would be purchasing your firm, factors to consider, firm valuations. I saw that it was either second or third place on the poll was maximizing firm value. So we'll talk a lot about that. We'll talk about different types of deal terms and deal structures, and then a general guide to smooth transition. A little bit about us. We've done 3 acquisitions the last 12 months, but we've talked to over 75 firms. We're a little bit picky on our side on which firms we believe will be a long-term success with us, but we've had a lot of experience in talking to different types of firms. The bulk of all of our partners were all ex-Big Four, and we have a couple thousand clients. We're registered PCOB, AICPA, obviously, and all the other regulatory bodies. So with that, I'd like to welcome Susan. Susan, are you there?
I am. Hi, Derek. Nice to join you today.
Yeah. So I guess, Susan, do you want to kind of kick it off and tell us a little bit more about yourself? Looks like, you obtained your CPA license in 92 and then got master's in tax in 99. I'd love to hear a little bit more about your journey.
So I went to school in San Francisco, University of San Francisco, and got my degree in accounting. Went to go work for BDO Seidman, or was Seidman and Seidman back then. Worked there for a few years, then went on to a regional firm, and then joined the firm that just merged in with Green Growth back in the early 90s. So the four of us, we built the practice up over many years, have a lot of local clients in the Marin and Sonoma County areas, a lot of high net worth individuals, a full service CPA firm doing audit and tax work. Really enjoyed working with the clients. And we had successfully had the firm going for over 40 years. But then it became time to look about how would we exit? And we were looking at some different options. We obviously had internal staff that we had talked to, and some people just didn't want to take on the responsibility of being an owner. It wasn't what their career path was going to be. Some people, still raising small children, and so they just didn't have the bandwidth. They liked doing the work, they liked the clients, but didn't want to take on the responsibility. So we had looked at a few different options. We did talk to one person who was going to be backed by private equity, which we were a little concerned about, because just thinking about, is that going to make the practice focus be less client oriented and more about satisfying the private equity that had to be paid back from the new buyer? And the partners had different levels of wanting to be able to stay on in terms of continuation. So we also looked at a business broker, which is, with an audit and tax practice together, is a little bit more challenging to find the right buyer, because there seems to be a lot of people out there who want to just buy a tax practice, but our A&A engagement was so integral to our tax practice that they really needed to stay together as a group. And then what happened is one of my partners had a major health issue. So that really accelerated the whole process, where we were concerned that if we needed to find a solution that we thought would work for us, our clients, and our staff. And so we were looking at different options, and we were contacted by someone from Green Growth, and just began our initial discussions, looking at, did they have the bandwidth to take on our clients? And similar to most other CPA firms right now, finding qualified staff is extremely challenging. Our area is even more so because we're north of San Francisco, so we compete with people in San Francisco. And also our counties are very expensive to live in. So it's difficult for less experienced staff to be able to afford to live in the area. So when we met with Green Growth and their staffing solution, which was to staff worldwide, that was a way for us to be able to have the staff we needed without having to try to set up the infrastructure ourselves. We were too small to be able to have the robust recruiting and the staff management tools you would really need to have if you were going to have an international staff base.
Definitely. As you guys work through the process of finding the right firm to take over the clients, what was like the most stressful aspect of it?
Making sure the firm would have the staff that was trained to be able to serve our clients well. Because, since we were a smaller firm and we had a lot of personal relationships with these clients, some of them were beyond just doing their tax work. They were personal relationships. We had worked with clients for many, many years. And, they were in certain industries, like we tended to focus in certain areas, but we had so much history with the clients. So because we'd had a stable staff for so many years and stable, management group, we had so much knowledge that was in our head, that was just from experience, and figuring out the best way to transfer that knowledge and making sure that we were working with staff that were really engaged and trained, and would want to have that kind of client relationships, just like we did, where, pick up the phone. Yes, there's some emailing, but you need people who are going to be proactive and really reach out to the clients to engage with them so we could do the handoff. It wasn't like the four of us were disappearing tomorrow, but we wanted to be able to hand over that responsibility so we could work on the transition part. And also the other part is when you have a small firm, you wear a lot of hats. You're doing HR, you're doing administration, you're doing billing, and to be able to move over to a larger firm where there's much more infrastructure on the administrative side, to take the burden off the partners so they could focus on the client transition part and be done with some of the other administrative tasks that they really had to manage on a daily basis.
Yeah. And were all the partners aligned in the retirement kind of timeline, or, were there kind of differing thoughts? I mean, or were you guys all on the same page?
Well, so the one partner who had the health issue, she was married to another partner. So that basically was 50% of us were kind of preoccupied or needed to focus on that aspect. One of my other partners, she had been very clear that she wanted to retire at the end of this tax season, the 2024 tax season, whereas I'm the youngest of the group, and I wanted to continue working for a few years. So, and I love working with my clients, and I love working with the staff. And if I could find a way to move over some of the administrative duties I had responsibility for, I was more than happy to do that so I could focus on what I really wanted to do.
Yeah. And if you were to go back a year and give yourself advice, what would that advice be?
Timing, because of the timing that we were going through, because it would happen, we had to accelerate the process because my one partner's health issue. It's best to be able to have all the clients on board before the end of the calendar year, typically, just because the transition, like if you have to transition software or you're getting ready to transition, you're going to be sending out your tax organizers or tax documentation. It's best to really get that done early, because if you wait too long, it can really back up the process for tax return preparation in the busy season, and then it gets hard to catch up.
Yeah, absolutely. And for those people on this webinar today that are kind of early in the process, what type of advice or things would you give them or tell them to kind of consider as they go about this journey?
I would say really being able to gather your information together, your internal financial information, so you know what your practice is really worth. That was part of our process. We had a little bit longer time period, but understanding, your billable hours or what you're charging your clients and how that would switch over to a new structure, and what's the smoothest way so there's less bumps in the road. Because I know when we started really digging into some of the numbers, we knew we had a successful practice, but until you really start analyzing the numbers, you don't really know what your practice is worth and how it should, the best way to be valuing it, and also to think about how involved you really want to be going forward.
Yeah. Could you elaborate on the last point?
Well, so for example, like my case, I stayed really involved during tax season to try to train up the staff and do the transition, whereas two of my other partners wanted to take more of a step back. They were involved some, but I think they thought they might be involved more. But if the staff can take over and that's something you want to do, is just being available for the transition. And it's not possible to do a memory transplant of 30 years of working with a client in one tax season. It takes time. And depending on how well things are documented in your working papers, it may be more challenging to move some clients over than others.
Yeah. Speaking of working papers, could you I know we've talked about this issue a lot, but could you, elaborate on the
Yes.
5-ton office file
So,
folder?
yeah, so we had been transitioning to electronic, and our accounting and auditing practice was completely electronic before the merger. But our tax practice was not as electronic as it could have been. And we also had quite a bit of paper and storage, which we're still trying to work on transitioning. So that would be something that if you're thinking about ever wanting to be able to transition your practice, is really getting your documentation all scanned in, electronic, because no one wants to go look at paper, no one wants to store paper. Offices are not being staffed all the time anymore. So that's really a critical factor to think of how you can get to the 22nd century of no paper existing anymore, and how you do that data interchange even with your clients electronically. Same thing, we had gone more electronic, especially with COVID, when no one was coming into the office, but still there's always some clients who that complete jump to electronic is challenging for them, and making them feel comfortable with that transition.
Absolutely. We have a question from Ryan Dawson. How did you guys come about partnership buy-in, and how did you calculate that amount? And over the past 30 years, did you have more partners? Did other partners exit? And how did you think about what a new partner could buy in, and what does that look like?
I mean, we were using probably the standard formula of 1x annual billings, and looking at that being the value. And then depending on how much someone would want to, if someone wanted to stay on, they might take a discount of less than 1x if they did not. And if they did, and they were willing to stay on for a longer period of time, there might be a higher buy-in because of that additional transition time.
Absolutely. So valuation one time, and then whatever percentage ownership they'd want to buy in, you would allocate. So round numbers, if it's $1 million firm, buy in 25%, $250 buy in.
Yeah.
Awesome. Okay. Well, thank you so much, Susan. And for all the audience, she'll still be on the webinar. So if you have any questions for her, just please drop it in the Q&A, and we'll get to it right away. So as Susan mentioned, there's pretty much 4 big issues that we see with retiring firms. One is a partner health issue, and for better or worse, it just comes out of the middle of nowhere. And so as Susan was saying, you want to plan for a retirement maybe 2 to 4 years out, because you don't ever want to put yourself in a position where a partner has a terminal cancer diagnosis and then you're trying to do a rush sale. It will not end favorably. Other issues are, recruiting challenges. And as Susan brought that up, a lot of younger people in public accounting don't really want to take on the stress and the liability of being a partner. And so, selling internally and selling down can also be an issue. There's largely 3 different avenues for retirement. You could sell to the internal partners, and generally what we've seen is it's generally paid out over 10 years, so 10% per year of the value that's being sold, and that's usually good for like security, in meaning exactly who you're going to sell to, that there's client continuity, that there's going to be no issues, but usually the terms aren't very favorable. You're waiting 10 years to get paid out. So it may or may not be the right choice for you. Another option, such as the one that Susan took, is selling to another CPA firm. I think it's really important, if you do sell to another CPA firm, to do your due diligence. What's the staffing look like? What do their operating procedures look like? We've always seen issues when you sell to a smaller firm. It may be a local firm that you trust, but they're smaller and they just don't have the capacity or their operating procedures to manage a larger client base. And then the third option, which many people now in public accounting are talking about, which is selling a private equity firm. That's usually best for financial return, but there's no real consideration for clients or staff. when you sell to private equity, they are generally a 3, 5, or 7 year fund, and they have to show a return on their investment. So, generally they'll just juice up the billing rates and just kind of squeeze everyone out. So it's great for a good exit, but if you live in the same city that you service a lot of your clients, you may not want to see a lot of your clients after you sell to a private equity firm. So, just be mindful of who's going to be taking over your business. This is kind of just walks it through. Another potential avenue is to sell through a broker. The financial returns can be good. It depends on the size of your firm. So generally, they have these, practice sales, these brokers. Their generally sweet spot is like about $1 million to maybe $1.5 million firm. Generally, the billing rates are kind of lower, and they're not as the client base isn't that strong. It's generally usually lower billing rates, but you'll generally see a higher down payment. So it could be an option for your firm based on the size of your billings.
I'll jump in here, Derek, if you don't mind. It's time for the next polling question. Your next question is, when do you plan to transition out of your CPA firm? Your choices here are A, within the next 6 months, B, 6 months to 1 year, C, 1 to 3 years, or D, not sure yet. So you have 4 options here. Please select the one that best describes when you plan to transition out of your CPA firm. If you don't know when that is yet, I would just select the one that best describes the hypothetical situation or what you plan to do in the future, or were you plan to transition out of your CPA firm. So again, the options are A, within the next 6 months, B, 6 months to 1 year, C, 1 to 3 years, or D, not sure yet. So that D option also works there if it's something that you're not currently doing and you're still evaluating. So 4 options there that kind of cover the gamut. I'll give everyone a final few moments to make sure everyone's response goes through. And I'll give everyone a final 5, 4, 3, 2, 1. And it looks like the majority are not sure yet. So still evaluating. A good time to join this webinar. So back to you, Derek.
Awesome. Thank you so much, Danielle. So these are the 3 primary factors to think about if and when you're selling your firm. So clients, staff, and valuation. And generally speaking, when you meet with a potential buyer, you generally want to rank these 3 items in terms of what's most important to you. And so, oftentimes you'll see valuation be number 1, or conversely, staff will be number 1. And it's important to really hone in on what's important to you before you try to sell, and then maximize for that. So for example, a lot of people will say that, keeping their staff in place, keeping the office in their office, that's like really important to them. And, you really want to make sure then you vet a firm that's going to continue that. If your primary consideration is just valuation, then it depends on where you fall on the scale. So on the next slide, you'll usually find firms that are under 2 million will generally sell for between 0.8 to 1.1 to 1.2 times earnings. The variation really depends on the client billings, as well as any sort of niche or specialty. Once you get into like the $2 to $8 million range, you'll either see 2 things. They'll either trade for 1 or to 0.8 times earnings, or they'll trade on a multiple of earnings. So it's either 0.8 to 1 times gross, or a multiple of earnings. And what's really important when you're in the $2 to $8 million range is to show that you have really strong operating procedures, and you have a very clear way of how the company runs, as well as generates profits. What generally is kind of a bad sign is when you have like a $5 million firm and 80% of the billings are tied into one partner who's billing out, over 4,000 hours a year. In that case, there's a huge key man discount. And so you'll generally get a buyer who's a little bit reluctant to want to make a big spend because, the primary factors for risk is that, once you buy the firm and you replace the retiring partner, then everyone leaves. So you have to be mindful of that. A question we just got from Patricia is, when you refer to earnings, are you referring to gross revenues? No. So earnings is actual profit. So you have in the $2 to $8 million range, it will trade for maybe 1.8 to 1 times revenue or a multiple of earnings. And we've seen anywhere between 3 to 5 times earnings. So as Susan mentioned in the beginning, it's really important that once you do go to market, you get all your financial ducks in the line. And from personal experience, it's almost comical how many firms we've talked to that have terrible financial records, just like the worst. We met with a firm once that didn't even know what their billing software was. And granted, this was one of the retiring partners. And I believe his other partner was the business guy, and he unfortunately had a terminal cancer diagnosis. But it's really, really important that you clearly show what is your revenue, what are your costs, and what's your profit. Because especially when you're selling a PE, if that's your primary goal, they're going to want to know what's the key man discount and what's the ROI and what's the replacement cost. So they're going to have to run through various financial scenarios to determine where you fall and what they're going to offer to you. It's really, really important to look at those things. And then firms above $8 million, it's a little bit smaller of a market. Everyone kind of knows each other. There's a couple really great brokers out there that do a lot of the big deals, and that's almost always on a multiple. So the other thing that you could potentially think about if you are in the $8 to $10 million range is a potential PE buyout. And so sometimes a PE will come in. And one of the key things to think about in terms of private equity investments is, are they taking a majority or minority stake? And, we've seen private equity come in anywhere between 5 to 15 times earnings. It really comes down to how good is the company operating, how good are their operating procedures, and how well can the company run without that retiring partner leaving. Patricia asked another really good question, which is, how does it differ for firms with niche? And how about firms that are 100% virtual remote? So we have seen remote firms trade for up to 1.5 to 2 times earnings because there's a huge buyer pool, right? Because when you're a remote firm, you can sell to anyone in the US. So your buyer pool's really large. So we've seen remote firms that bill well generally sell for a lot more. Additionally, firms with niches, it depends on the niche at the end of the day and how powerful that niche is and how technical the barriers to entry are. So, we talked to a firm that had a special niche in credit unions, and, they were looking for around 1.4 times revenue, and they were well above the $8 million range. So, the stronger in the niches, the more you have a brand presence, the more there's a technical moat, the higher the value. I think for us, what we've seen has generally been the worst type of valuations are low tax prep fees. So, average 1040 fee being under $1,000, and or public company audits with low fees. I mean, I'm sure for those of you that are on this call that do public company audits, not a real pleasant time to be in the space. So, if you do have a public company audit book of business, it's going to be pretty challenging for you to sell your firm because there's just a lot of liability right now doing public work. So those are some things to consider. So these are some different type of deal terms you really want to think about as you sell your firm. So the number one most important thing I would say potentially is a retention clause. Most, if not all, buyers who know what they're doing is going to ask for some sort of retention clause because clients leave. I think in financial services, there's generally a 10% annual churn on clients. So a retention clause is really, really important. I've seen them be anywhere between 1 to 5 years. On the flip side of a retention clause is also a client replenishment clause, which pretty much says, hey, during the retention period, if any clients leave, we can replenish them with new clients. So it won't really beat up your valuation, and you'll still get paid the same amount over the same period of time. Client replenishment clauses are actually really great when you have a huge inbound lead flow, but you're unable to service those clients because of staffing issues. So the two kind of work as two levers, but sometimes you can even ask for a client replenishment clause that goes above the initial valuation. And that's something you could always work out with the buyer. So for example, if you lock in $1 million valuation, but there's a client replenishment clause that allows you to bump the purchase price up to 1.2, a lot of firms would be open to that. A question from Elena, could you repeat what does private equity look for, i.e. revenue size, etc.? It really depends on the size of the private equity firm. What we've seen over the last 3 years is private equity went to kind of the top 25 firms. So they went to the top, and now it's kind of trickling down. So it really depends on what the size of the firm is looking for. Are you a platform or are you an individual firm? So a platform is a firm that goes out and acquires other firms that grows really quickly, or do you just have kind of your little, niche? So for example, if you're just servicing clients in Nashville, Tennessee, do you just have a specific niche? It really depends on the size of the private equity firm and what their long-term goals are. Most private equity firms are, in this time right now, they're trying to do a roll up. So they're trying to buy as many firms as they can, roll it into one big company, and then sell it off to someone else. So that's kind of generally what they're looking for. Why private equity is so interested in accounting right now is because, as everyone on this call knows, most clients don't leave their accounts unless you do a terrible job. But more oftentimes than not, we have really, really good retention. Another question from Alex Moore: how do multiple valuations range very relative to firm service offerings, tax versus audit versus advisory? That's actually a really good question. Thank you, Alex. Tax, as Susan mentioned, oftentimes are really interesting to a wide range of buyers. You'll see valuations for those, generally on 1, maybe higher. If we talked about a remote firm, maybe 1.5 to maybe 2. Audit is generally a little bit harder to sell. If it's, AI CPA audits for, HOAs, for example, something pretty relatively low risk, you might be able to find a good buyer for around 0.8 to 1.1 times earnings. But if it's a public company audit, the market's hard. Advisory actually sells pretty well. Like if it's a really good advisory practice, then you can sometimes get a fairly high multiple on it. The issue though with advisory is there needs to be a really strong succession plan. So you need to have really good people in place that are willing to stick around with a new buyer. Advisory for sure, more than probably tax and audit, is a human capital game. So you have to really show how it's gonna how the business will continue without the main partner in the company. Another question from Ken Alvarez: why are the multiples for financial firms so much higher than our industry? Great question, Ken. I wish I could tell you. I think from what I'm seeing is the liability associated with the public accounting. So, you sign off on, especially right now, if we look at, public company, the PCOB and a lot of enforcement action, there's just a lot of liability in the accounting space right now. So I think there's that aspect. And I think the other aspect is just the talent shortage. So, you buy someone's firm and, the main partners leave. Are you going to be able to keep the business going, or will all the clients leave? This isn't like a fixed asset or like a trucking company where, you just have to deliver trucks on time and you can find new truck drivers. There's such a key element of human capital here that, once the main partners step out, there's a huge liability that the clients will step out as well. Question from Tom Jennings: what about firms with a good bit of payroll service in it? How does that affect a multiple? I think that's a really good question, Tom. I think it depends on what we've historically seen as the hourly rate. Payroll services in general are not big money makers, and there's a lot of companies like ADP, Paychex, Gusto that do automated payroll. So, we looked at a firm in the Midwest, and they were doing payroll at like $100 a pay period. So, the reality of that is just not really worth that much. Some good benchmarks to note: Intuit is launching a online tax service offering that does corporate income taxes, and they're starting that at $1,700. And I know for people that go to H&R Block, I've seen their fees for basic 1040 W2 Schedule C, $600 to $900. So when you're trying to go to market and sell your firm and you're charging less than what H&R Block charges, then there's a bit of an issue, because the buyer comes in, doubles fees, and everyone leaves. What exactly do they buy? So that can be an issue. Another question from Brent was: how do you see valuations for firms working exclusively with business and owners using a subscription model and very few standalone individual taxes? That's generally the best case scenario. If you're a tax prep firm and you're working with businesses, it's always better than a big 1040 shop, unless it, of course, is like high net worth individuals. Another thing that a buyer, private equity firms look for is: how do we upsell their clients? How do we get our ROI? How do we charge them more? And so when you're servicing a lot of businesses, you can also provide monthly accounting services. You could close their books. You could do all those things. So what's important to think about when you look at your firm is who you're servicing, what are the services that are being provided, and how would a new buyer potentially grow the business. Another question from Alan: is there a market for a low gross, under 150K, no staff, totally remote tax practice? Definitely. I think, Alan, for you, where you'll probably get the best valuation is probably like an accounting practice sales. You could probably list it. You could try to list it high, maybe 225, 250. You might be able to do like a higher percentage down. The thing I would say, that the only good thing about a low revenue accounting firm is that there's a huge market for buyers. So, for you, I guess, Alan, it could be, an endless, stream of buyers, especially if you're not registered with the AICPA and you don't need a CPA license. There's a huge audience for you. So 2 more deal terms that we should probably talk about, which is a ceiling and a floor. So a floor pretty much says, hey, even, regardless of the retention period, if it's $1 million firm, for example, you will get paid out at least $750,000. So regardless of what happens, we need to put a floor in here. And then a ceiling also works in the reverse. So usually the valuation and the ceiling are generally aligned, but it's on a case-by-case basis. So here's kind of like a smooth transition guide, and we can also send out the slides if that'd be helpful for everyone. But I'm sure everyone on this call has been contacted a lot by private equity firms, other CPA firms. But one of the kind of most important things to do if you are in the market of finding the successor is getting the confidentiality and the NDA agreement signed right away. Like, those are really important. You just want to make sure that the clients don't know what's going to happen until something is solidified. And then thereafter, you jump into the due diligence stages. What I would recommend to anyone and everyone on this phone, on this webinar, if you're looking to sell, is get an LOI out as early as possible, just like basic broad terms. So what are we thinking about valuation? What are we thinking about retention? Is there a ceiling? Is there a floor? The worst thing that you could do is spend 3, 6, 8 months with a firm, and then at the end you realize, oh wow, these guys actually are very unqualified to manage our firm, or they don't have the funding, or they don't have the resource, and then you have to start all over. The only good thing in that instance is if it did force you to collect all the documentation up front, then you will easily be able to take it to another buyer. So a good question from Lynn. We're about 40% single audits. I'm Lynn, correct me if I'm wrong. I'm gonna assume that's AICPA audits and not PCOB. 40% tax, 10% bookkeeping. We're definitely bill on the lower end. Thoughts about what we can expect. Revenue is around 650 to 825 range. I guess, Lynn, what I would say is, where are you located? So as Susan mentioned, if you're going to be selling another local CPA firm, they may want to be in the same state as you. Obviously, if you're doing audits, you may have to register in different states based on the different filing requirements. But probably around 0.8 to 1.1 times billings, probably 3 to 4 year retention period. And then I think the devil's in the detail. So what are the individual billing rates? What are the audit fees? Are you doing reviews for between 15 and 25K? And audits, AICPA audits between, let's say, 25 to 125K. Like where do you fall in that range? The better the billings, the better the valuation, and the reverse is true. Another question from Raymond. For CPA firms that are registered investment advisors, in addition to providing tax services, is the firm more marketable separating out the services into separate business units? That's actually a really good question, Ray. Thank you for bringing that up. For service lines that are a little bit more high risk, so for example, public company audits, generally what you'll see that if you're selling to a private equity firm, they'll kind of separate those liabilities out, and they'll do generally management agreement, because I'm sure, as you're all aware, licensed CPA firms generally have to be majority owned by CPAs. So they'll do some sort of management agreement to kind of pull the cash out. That's generally how they'll do it. But for you, Ray, you might have a little bit of a smaller pool. Like the more licensing requirements you have, it just takes a more specific buyer. So it's really important to find that. Question from Esther Mills. Can you address issues with sole props? Sole props can actually be a really great thing. I've noticed with all the firms that we've talked to, I think year to date, we're actually close to about 100. Sole props actually can be quicker sells because there's less people to deal with. So we talked to this one firm. There are about 5 partners. Two were going to retire, and they were the majority owners, and then 3 were staying on with the new buyer. And honestly, no one could agree on anything. It was the most frustrating, annoying thing I've ever dealt with. But every single partner had their own kind of perspective, and I think that's why you're seeing a lot of large, the top 10 firms moving away from the partnership model, because no one can agree on anything. So EY was going to try to do that big breakaway this year, and they didn't. I think it sounded like, based on what I read, a lot of the partners couldn't agree. So, oftentimes the sole prop, if you're a sole prop billing out $4 to $5 million, you have great fees, you'll be a quick sell, and you'll find probably a lot of really qualified buyers who would be super excited to take over your clients. Question from Robin. For a sole proprietor with small business clients and related 1040s, where is the best source of potential buyers? Where should I advertise? Robin, it really depends on where you fall in your billing rates. If you want, at the end of this webinar, I have my email address up. If you want to send me just like a quick note on the overview of your firm, I can just let you know what market or marketplace would be the best. Okay, so anyways, after the LOI stages, then you guys will have to do the due diligence. Depends on the size of your firm, will depend on the complexity of the due diligence. It's really important that you try to document how your company operates, because the more you can clearly show how your company runs, the more people will be excited about the business, right? Because, imagine taking your firm to market, and you're like, okay, this individual does all practice management, this individual does all HR, this individual does, billing, ARAP, and you can show clearly how the company will run after you're not there. A lot of people can envision themselves running your company, but if you go to market and you're doing all the work, and you don't know where everything is, it will look a little bit messy, and so you might scare away some buyers. But again, it really depends on the size of your firm, your annual billings, as well as your individual billing rates. So quick question from Neela: how does carving out some clients like family and friends from the accounting clients that will be sold affect the process and purpose? Obviously non-compete for other clients, but how does that affect the transition? That's actually a really good question. Generally speaking, and this isn't always the case, but friends and family aren't, you generally charge your friends and family less unless they're ex-husbands or wives in their respective families, in which case you might charge them more. But more oftentimes these billings are usually lower, so a buyer probably wouldn't even want them. If you're charging your brother, your sister, and your in-laws and your kids, half the market rate, the buyer probably doesn't even want it. And so what I would say there is, when you go and take your firm to market, you generally want to list out all the clients and their respective billing rates, so there's a clear delineation. I don't know if you need to do a non-compete. I know in California, non-competes are non-enforceable, but I would just clearly line out, which clients are moving over and which are going to stay. And, I think one of the most important things to remember is that this is usually a multi-year process. For a good firm, I've never seen it be a single year process. So, you also want to pay attention to, how does the counterparty negotiate? How do they work with you? Are they just trying to beat you up on valuation, or are they really trying to partner with you? Because to have a successful transition, you need to have a firm that's willing to work with retiring partners, that's willing to, create synergies to increase value. So, you really want to be mindful of how they treat you in the negotiation stages, because that can oftentimes be an indicator of what it would be like working with them. Sinclair, please send me a note after. Happy to help any way I can. Andrew, how do you secure your deals? So how do you know you'll get paid? I think the question I'm seeing, Andrew, and confirm if I'm mistaken, but the question is, how do you know you'll get paid if it is on a retention basis? And again, that ties into having a good relationship with the firm. So what you could put in the agreement, if you're worried about not having financial visibility into the deal, is just requiring that on all invoices that are being sent to your clients that you're selling, that you're CC'd on those invoices. It will flood your inbox, but you'll make sure you're getting paid. That's one way. Or two, you could put a provision in the agreement that you can audit the company's books at any point in time under the retention period. And so, if you're an auditor by training, it's something you could probably do in your sleep. Okay, let's see here. We got Elena. In terms of revenue, the firm becomes interesting to private equity when the revenue numbers exceed 4 million annually. Elena, it really depends on the size of the firm. So we've talked to a lot of large private equity firms. I would say in the last maybe 3 or 4 months, we've talked about 20 firms. I've seen a lot of them that don't want to talk to firms under 50 million. So for everyone on this call, if you have talked to private equity firms, you need to do your homework on them. What I personally get contacted maybe once or twice a week by a quote unquote private equity firm. They're not private equity firms. They will come to you, they'll put you under LOI, and then they're going to go and try to raise the money. That is the biggest waste of time for you guys. You need to make sure they have the assets under management, that they can actually execute on the deal. I would totally ask for a proof of funding. The number one thing you definitely want to avoid is someone who's going to tell you they're going to buy your firm. You go through the due diligence process, and then at the end, they're like, okay, now we're going to go raise the money. Like, talk about a waste of time. Just avoid that at all costs. Alan, what do you consider to be good billing rates for a small tax practice? So Alan, I've generally seen 1040s around 11 to 1500s, and then corps, and these are like non-complex, non-high worth, and then corps anywhere between 2500 to 6000. If it's like a complex 1040, maybe 3, 5, 8, $10,000. Things to look for is like billing rates and how long it takes. But in terms of good billing rates, those are oftentimes a little bit more confusing and a little bit more complicated to spot out, but bad billing rates are really easy to spot out. Bruce, can I take 25% of my clients and sell the remaining 75%? Absolutely. I think, if you were to say, hey, we want to keep the advisory or like high net worth stuff and we want to sell everything else off, for sure, that's totally doable. So long as, you're selling off the 75% is like good billings, good clients. If you're just selling off the junk, you may get a junky offer. All right, and then we have, let's see, Patricia, any recommendations for succession planning, selling to key employees? That's a really, really good question. You're generally going to look at a 10-year payout. So let's just say you're selling out your portion of the business for $1 million over 10 years. So you'll generally get paid $100,000 year over year. I think if I were in your shoes, I would have that person operating as a partner at least a year before they take it over, and try to be as uninvolved as possible during that year to have pretty good assurance that they can actually run the business while you're not there. Question from Brian, does having a small satellite office hinder any deal? Can you sell it separately? Not at all. We actually are working on a deal right now where they have 3 offices in the Bay Area and they're looking about selling 1. So, again, I would just treat it as a standalone P&L. What does the billing rates look like? What's the profitability there? Is there a big lease? I think some of the struggles firms have when they're still brick and mortar is that they have these massive leases. And, when you look at the profitability, it's, sub 20%. And so then, for a potential buyer, they're going to try to buy you on a multiple of earnings, not revenue. Question from Jim, how long before you retire should you start to look to sell your firm, as you don't want to start too early or too late? That's a really good question, Jim. And we actually, a lot of our discussions now are like, when's the right time? I would probably say maybe a year to 2 years before you'd like to retire, because the reality is once you do retire and you sell your firm, you're still going to be involved a little bit to the extent of like client relationship and transition. So, I think it's always, retirement's a one-time lifetime decision and it's deeply personal, but think of it this way: when you do retire, you're not going to fully exit. You will still be involved to a certain regard, primarily around client maintenance and relationship building. Question from David: are you seeing more and more firms wanting to sell at this time? Yes, that's absolutely right. And generally a big red flag is someone who's trying to sell their business February 1st, right? So, if it's February 1st and someone's trying to come to you and looking for a quick sell, is probably a red flag. There's something funky going on. I don't know as a buyer if we would do it, but even if we did consider it, it would probably be a referral retention based deal, because there's a huge red flag. And I think, to go back to circle on Jim's question, planning is always important. You don't have to sell until you feel ready, but you want to plan, you want to put the feelers out, you want to talk to different buyers, and you want to feel good about who you're selling to. So you definitely don't want to do that last minute. Question from Joyce: what's your guess on a nonprofit niche? 75% audit, 25% nonprofit tax and accounting services, remote, but most clients in Eastern Metro City. That could be a really good firm, Joyce. Nonprofits usually don't have a ton of liability. Please email me after if you are interested. We have a big nonprofit niche, but you're looking at maybe 0.9 to maybe 1.1 times earnings. Depends on the billing rates. Philip, what do you consider as earnings? Really good question, Philip. It depends on who you're going to sell to, because private equity for sure, and sometimes other firms will include a replacement cost in earnings. So, what we see a lot of firms do, and no fault to the firms, they'll show their P&L minus what their cost is. And so you'll see like a big number, 50, 60% net income, but they're factoring the main partner who is 80% of the revenue. And so there will be a replacement cost in there. So that you have to kind of negotiate with the buyer to see, hey, are we going to include a replacement cost? Yes or no? Notwithstanding that, it's just basic profit.
Hey, Derek, sorry to interrupt. I just want to make sure we get to the final polling question before the hour runs out so everyone gets their CPE. So I'm just going to quickly, and then I'll turn it back over to you to answer more questions, but just in case people have to leave at the end of the hour. Your final polling question is, what factors are most important to you when selecting a buyer for your CPA firm? Your choices here are A, financial offer, B, continuation of client relationships, C, cultural fit and firm values, D, buyer's experience in managing a CPA firm. So once again, 4 choices here. Please select the option that best describes the factors that are important to you when selecting a buyer for your CPA firm. Give everyone sufficient time. This is your final polling question, so make sure you get it locked in. Make sure you hit the radio button next to the choice that best describes the most important factors to you, and then click submit to ensure that your response goes through. And then we can turn it back over to Derek. I know we have a lot of good questions coming in, but just want to make sure everyone gets their CPE credit with the polls. So I'll give everyone a countdown of a final few moments to get those responses locked in. A final 5, 4, 3, 2, 1. And it looks like it kind of runs the gamut there. I will turn it back to where you left off for the final couple minutes here, Derek.
Okay, awesome. Joyce, do you suggest keeping a portion of your firm's name in the new firm? I think that really depends on the buyer. And I also think that depends if you want to keep working, right? Like the last thing you could do is add Miller to the name of the new firm and then leave. You know, that wouldn't really make sense. So, you know, I think what you're alluding to is more of like a merger than an actual acquisition. David, how often do you see seller's remorse? I think you probably see a lot more on the accounting practice sales side. There's a lot of people that use APS at the lower end of the market, and they're selling. You could see a high down payment, but you're generally selling to people who've never run an accounting firm, and they think it's like some sort of cash cow. And they don't realize that you have to provide good service. You have to be technically accurate. Like, you know, buying an accounting firm is not buying a laundromat. You can't just let it run. You have to actively, you know, help out your clients. Neela, what is the difference between Green Growth can do help sell versus something like accounting practice sales or similar different services provided to small firms? Does Green Growth sell firms for other firms? Good question. We aren't a broker. We do buy firms, and we're actively buying firms right now. So we've talked to a lot of different firms. I could, you know, if you have an overview, I could kind of generally point you in the right direction, but we're not brokers. We're a CPA firm. David, thank you as well. Really appreciate it. Awesome. So yeah, here is about us. If you guys have any questions, feel free. My email is is right here, derek@greengrowthcpas.com. You can check out our company. We have offices all over the West Coast, and we're actively trying to expand throughout the United States. Last question from Scott. Would you buy a CTC rather than a CPA firm? I think at the end of the day, it just really comes down to the billings and the services offering. We'd be open to looking at all firms.
Great. I think we're at the end of time. Derek, is any other final thoughts? I know you covered a lot of questions here, and I want to thank everyone for having such good questions come in. Derek, thanks for such a great presentation, and to Susan as well. And I just want to thank you all for joining us today. Thank you so much.
Yeah, thank you, everyone.
Thank you.